Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Anthony Carfang, Managing Director of the Carfang Group, and Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Tony and Paul.
Thank you, Push. Nice to be here.
Yeah, thanks, Push. Appreciate it.
Thank you for taking the much needed time to share your thoughts with us on topics that impact the world of cash and treasury management. It is time we dig deeper and look forward to gaining some deeper insights from you on our topics for today, namely wholesale CBDCs in cross-border payments, US debt ceiling impact and upside risk for the dollar, the Japanese economy emerging from recession, and finally, talent scarcity in treasury and finance departments. Our audience can read these articles and also research content more deeply by visiting CTMfile.com or by following the links in our show notes. Let's get started with our discussion. Our first story for today is about the Federal Reserve Bank of New York and the Monetary Authority of Singapore exploring potential for wholesale central bank digital currency or CBDC in cross-border payments. The Federal Reserve Bank of New York's New York Innovation Center and the Monetary Authority of Singapore have published a research report detailing the results of the joint project CEDAR Phase 2 and the UBIN positive experiment. The technical research experiment demonstrated that distributed ledger technology or DLT could support cross-border multi-currency payments and settlement enhancements. Tony, if I may start with you, what do you make of this joint experiment and that CBDC supported by DLT can play an important role in easing wholesale cross-border payments?
Well, Push, multi-currency cross-border payments have long been the bane of many corporate treasurers, taking a long time to settle and, fraught with risk and uncertainty. So clearly, this is a good thing. The fact that it can be done with the distributed ledger clearly is a step toward digitization and digital currencies, although this wasn't a digital currency that settled. It's encouraging that they were able to conduct this experiment and complete a transaction start to finish in less than 30 seconds. That's impressive. On the other hand, completing a transaction versus creating a payments ecosystem are two very different things. I would liken this to, we landed a man on a moon. We have not colonized the moon. And so, I'll turn it over to Paul for further thoughts, but I think there's still a long, long way to go here.
Yeah, Tony, I'd agree. I mean, there's definitely a long way to go, but the fact that they're using DLT tells me the prime and the pump to test CBDCs and see if that will function and behave the way they expect it to. Now, building the infrastructure to be able to do these cross-border payments, if you're able to solve that and solve it in a way that is scalable, then I think you really have something. And people out there that don't like the thought of using or the use of digital currencies, I don't think it's going away. It's just a matter of time before it's going to be a reality. And it's going to be part of what we use in commerce around the globe as central banks spend more time getting ready, prepared for this type of activity. I expect definitely in my lifetime that we're going to see this happen. So the next logical step for this test that they just ran, or this project, is it seems like to me the project really isn't done. They've taken step one, but the next logical step, I think, and I do like the use of the DLT. I think when you consider decentralized finance and centralized finance and the things that people are trying to do out there to prepare for the digital currency future, this is an important step forward. So I think they've got to consider, hey, let's take a digital coin and test it. Let's see if we can effectuate the transaction or multiple transactions and see what happens. It seems like the next step to me.
Yeah, and in addition to pushing a transaction through, there's the ecosystem issues would be things like the attendant payment information flow, the customer support that needs to take place around this, because the financial, if these payments will be originated through a service provider or a financial institution or whomever, there's going to be a customer service component. And while these payments in theory settle instantly, without the presence of a central bank as the financial intermediary, in the worst case scenario, I think, there are a number of issues that, frankly, we won't know until more experiments like these try to scale and we see what those issues are.
Yeah, I think that's spot on, Tony.
Wonderful. Our next story for today, which is the second topic, warrants discussion and pertains to the US debt ceiling standoff that, if isn't resolved or lifted, will likely cause severe damages to the US economy. It is believed that since 1960, Congress has raised, extended, or revised the debt limit 78 separate times. And now a team of strategists at BNP Paribas, led by foreign exchange strategist Alexander Jacob, said they expect the debt ceiling to become an increasingly important theme for markets, and a potential suspension may give room for the US dollar to jump. The US debt ceiling presents an asymmetric upside risk for the US dollar, in our view, the strategist wrote in a note. Tony, I know you know a lot about this subject, as does Paul. But Tony, if I could, ask you to answer this question first, do you think the political deadlock over the U.S. debt ceiling poses a real risk to the dollar? And are there any other impacts that can, given the breach of the debt ceiling, are there any other impacts that can have on corporate treasury and the U.S. economy at large?
Well, Push, there are so many dimensions to that question. Yes, it's a very serious risk. It's a risk in terms of credibility. It's a risk in terms of the creation of volatility and uncertainty. You mentioned that the debt ceiling has been increased several dozen times since it was first instituted. It's actually also been decreased 10 times over that period, which somehow is left out of the news stories. But under Presidents Truman, Eisenhower, Kennedy, and Johnson, that there were 7 occasions where Congress actually considered what is the proper level of the federal debt, and they came up with a number. And 7 times we reduced it, and 3 other times they actually cut the debt ceiling in half to force a default. This all happened in the Carter administration, where they would Friday night cut the debt ceiling in half, therefore creating a default, forcing Congress and the president to act before markets opened on Monday morning. And they did. And they did that 3 years in a row. It's quite a storied history. I think we have a fairly acrimonious debate, at least on the extremes of both parties. And if that plays out, we could have a stalemate that results in, let me say it differently, but we're already seeing distortions in the marketplace in terms of short-term yields spiking well above longer-term yields. There was a 21-day cash management note that the Treasury issued today at just under 6.2%. That's not a bad Treasury security. On the other hand, Treasuries went out because it's worth the risk of that being delayed or defaulted or whatever. But to the point of the article, at some point this does get resolved. So as bad as it might be until we get that point, once it does get resolved, there will be huge Treasury issuance to make up for the fact that there hasn't been new Treasury debt increases since the middle of January, and that clearly impacts international capital flows and will likely be very bullish for the U.S. dollar, as as the authors point out. That's true to the extent that the market hasn't already anticipated that and adjusted. This is just a case where there are a lot of wild cards here.
Yeah, Tony, there's definitely a lot of wild cards for sure. This isn't the first time we've been here watching our government negotiate terms in raising the debt ceiling. So it's not the first time, and these are negotiations. That's what's going on right now. If you're at the table negotiating, you're probably high probability you're going to do a deal. Doesn't mean that you don't have, to Tony's point, you have speculators out there. You have hedgers and speculators. Somebody's going to lose. It's a zero-sum game. But, there is that probability, that possibility that nothing gets done. So then the question is, what are the options? Well, the Treasury needs to slow down the pace of spending. Government needs to slow down the pace of spending. We need to somehow speed up the amount of revenues, that come in. There's the option of the president use the 14th Amendment. I'm not a lawyer, so I can't talk to the legal issues around that, but that's been floated. Another idea that's been floated out there that Janet Yellen calls a gimmick is the issuance by a Treasury of $1 trillion platinum coin. They make this platinum coin, they put it in a vault, and they issue debt against it. Well, do I think those things are going to happen? I don't think so. I think what's going to happen at the end of the day is they're going to broker a deal. And it may be literally at the 11th hour, but I think a deal is going to get done. I don't see the U.S. defaulting. I think it's something that would be catastrophic in terms of the impacts. And I mean that because it would be significant. Does that in the U.S.? No, it doesn't in the U.S. But is it problematic? Yeah, it's problematic. So it's definitely something I don't want to see happen. And I feel like our people that in position to make a deal happen don't want that to happen either.
So if we keep in mind, as Paul points out, is default likely to happen? Well, revenues coming into Treasury are far greater than debt service expense. And as long as Treasury prioritizes debt service above other expenses, there won't be a default. That means cutting back on many of the other things that Paul mentioned. If there is a default, that would be a political decision. That's not a financial imperative. It would be the government deciding that it's going to keep national parks open versus paying, redeeming an upcoming Treasury bill. And I think the end result of that would be fairly catastrophic. I do think there will be a deal here, simply because the results will be so catastrophic. But keep in mind, the Republicans get another bite at the apple here. The House of Representatives is where all spending bills originate. So come this September, when the upcoming budget, the next year's budget will be negotiated, is another chance for the Republicans to achieve some more of their objectives. And the following September be yet another chance before the next presidential election. So the Republicans could easily accept half a loaf here, declare victory, go into September, declare another, get another half a loaf, and the following September get another half a loaf, and they're up to 90% of what they wanted. So that's certainly the possibility. The other factor here is the political fallout. In these debt ceiling battles, typically the short-term advantage goes to Democrats. Somehow the Republicans always get blamed for wanting, to push grandma over the cliff, as one famous commercial did. But in the long term, I think you have a different issue, and that is the history books remember the president and not the Speaker of the House. So as the history books are now writing the history of the first downgrade of U.S. credit back in during the 2011 debt ceiling crisis. And remember that Barack Obama was president. Very few people today even know who the Speaker of the House was that was negotiating against him. Turned out it was John Boehner, and that's a name that will be merely a footnote in the history book. But the headline will be Barack Obama. Joe Biden does not want that.
No, he does not.
Those are precious insights, Paul and Tony, and I hope our audience is paying particular attention to your insightful comments. Moving forward to our next story, which is about Japan, the world's third largest economy, emerging from a recession and growing faster than expected in the first quarter of 2023 as a post-COVID consumption rebound offset global headwinds, shoring up hopes for a sustained recovery, while also fueling speculation of a possible early election and policy change by Japan's central bank. Tony, in the light of the global economic slowdown, what do you think corporate treasurers with exposure to Japan will make of Japan's sustained recovery?
Well, Push, I think it's very good news that Japan is recovering from COVID. Japan has had 3 decades of sort of economic underperformance, if you will. I mean, negative interest rates, zero interest rates for exceptionally long periods of time, but the underlying fundamentals were, an aging and declining population, the fact that they are highly dependent on exports for their economy. So, Japan is sort of an unusual case study here. The economic recession that Japan has had for the last few quarters, albeit small, just fractions of a percentage point decline. The growth of the most recent quarter, again, is small. Let's hope that's sustainable. There's a lot of Japanese debt on the market. Japanese government debt is, I believe, like 200%, 200 and some percent of Japanese GDP. It's hard to believe that anybody's been more prolific spenders than the United States, but on a proportional basis, Japan is. I think for holders of Japanese debt, the economic recovery is very good news.
Yeah, no doubt, Tony. Certainly the aging population is an issue for Japan. They've been facing that for quite some time. Extended low interest rates, real interest rates below zero or at zero. There's been a lot of challenges that they've had. And so the ability to have something that looks like growth in Japan really is significant. And to have it, over a couple periods is even better. The question I guess I have is, will spending by consumers and businesses be enough to offset any continued downturn in their ability to export goods and services? I don't know. Certainly looking at what's going on in the U.S., Europe, China, what happens there can have an impact on them. But the other thing that this article points out is, well, could there be a policy change with an election that could change things as they are? I guess I don't know. I'm not much into Japanese politics, but they did point that out. So there is potential there that there could be impact tied to an election. But this is definitely a good thing for Japan, and people got to be feeling, like, good. Hey, we got some growth. It's been so long, 3 decades. That's a long time. No growth. That's tough.
The geopolitics surrounding this are kind of ominous. I mean, the whole Pacific Rim macroeconomy is realigning and reshaping. The good news for Japan is their population aged. They've been aging for 3 decades. Ours is just beginning, and most of the rest of the world population aging is just beginning. China will be in a far more dramatic situation because of their one-child policy. They're already dealing with one person supporting 2 parents and 4 grandparents, and boy, that is simply not pretty. So we have factors on both sides of that. let's just hope Japan continues its recovery and can maintain its level of exports and maintain its position on the Pacific Rim.
Yeah, I think that's right, Tony. It's I've been to Tokyo. It's a beautiful country. I can't wait to go back and visit again. To the point on the aging population in Japan, the average age of life expectancy there is quite high. So, you have families supporting their elderly there for an extended period of time. I don't know what it's like in China, but China definitely has an issue coming up for them. One child policy, they've created a problem that is going to come back and bite them.
Those are important insights, and particularly, you mentioned aging, and both the Chinese and the Japanese economy, those economies that are aging, and India, which is, again, a part of the entire Asia Pacific ethos. They are the youth capital of the world, and a lot of corporates are looking to India as a suitable alternative to the world's oldest factory, China. Particularly the fact that of the top 5 economies, India, China, and Japan are, among the top 5. Germany and the US being the other 2. So that should be something very interesting to watch for. And like you said, I'm glad that I concur. I'm glad that Japan is making a sustained recovery. The world needs Japan. The fourth topic that we will discuss today revolves around the perceived talent scarcity in Treasury and Finance departments, with nearly 60% of Treasury and Finance professionals agreeing that their organizations face a talent shortage within their functions, according to the 2023 Association of Financial Professionals Compensation Report. Respondents cited the competitive job market and the increasing importance of attaining work-life balance as key reasons for this shortage. So, Tony, one is to keep the AFP 2023 AFP compensation report in perspective. The other is I'd like your and Paul's insights regarding the report. And from what you hear and see, Tony, do you concur with AFP that there is a talent shortage within Treasury and Finance? Yes or no? And if you do, what would you consider are, according to you, the major reasons for the talent scarcity in Treasury and Finance departments?
Well, Push, as I looked at the survey, it seemed to be not so much a specific shortage of talent, but lack of compensation, work-life balance, and other factors to attract that talent into Treasury, which is a slightly different spin on the issue. And as I read the article and looked at the survey, there's also an issue about upward mobility and career path through Treasury, and that kind of stuck out at me, because I think there's a lot the companies and treasuries can do to ameliorate those issues. I do want to point out, if you take a very long view and go back to before the AFP and think about career paths in Treasury, and I'm going way back, the treasurer was a career terminal position. A person was appointed treasurer because they were a very long-time loyal employee, just a few years away from retirement, and they were going to be rewarded by having their bankers schmooze them for the next 3 or 4 years before they retired. And it was the gentleman treasurer at the club kind of thing. I say gentlemen because at that time they were gentlemen. As the AFP, started to come into existence in the early 1980s, we saw another trend in Treasury where the gentleman treasurer finally retired for good, and Treasury became a career-building step where someone, without necessarily considering a permanent Treasury career, saw Treasury as a stop along the way of climbing the general corporate hierarchy. Then, as you had certification come in with the AFP, and frankly, money markets becoming much, much more complicated, we're now in a period where Treasury, is it's not a silo, but it's an arm of the corporation that can house many robust career paths. And I think the challenge, the undercurrent of the survey, is to provide those career paths in ways that provide the work-life balance and compensation that people need and deserve.
You really hit the nail on the head, because I remember starting out early in my career, people who were treasurers at the companies I worked for, they were long tenured. They got put in those positions at a point where they were getting close to retirement. I had one retire on me when I was at an insurance company. And, that was just common to see that. What I think is just really become kind of a unique situation for the treasurer position within a company is it's within the finance house. However, it's a great step for somebody that wants to do more, because the broadening of the treasurer role has become rather significant. So it's not just managing cash and making sure that we're getting the accounting entries completed. That's not what treasury is today. It's some of the blocking and tackling that you have to do. You have to do that. You can't not do that in the treasury arena. Now you've got a forecast. You have to report. You have to have capital management skills. You have to have short-term investment management skills. You have to understand the markets. You have to have the ability to hedge. You have to understand foreign currency. You have to understand all the rules and regulations, not only within the U.S., but there are many treasurers out there that are doing this globally. So the dynamics of the role has changed. It's become much more complex. It offers the opportunity for people to grow into other roles, maybe a VP of finance, CFO down the road, maybe even more. Who knows? But I think it's a great opportunity. Now, the question about, the AFP's report and the ability to hire talent, has that been a challenge? It seems like it's been a challenge to me, because I can tell you from experience, when I was on the corporate side of things as a practitioner, I had big challenges hiring people. It was twofold. It was two things. One, it was attracting the talent when I found it, keeping them engaged in the offer when they would get a counter offer from their current employer. And we would counter offer again, and their current employer would counter offer. At that point, they had about 20-30% raise. They're like, well, I'm not moving. So that was a particular challenge in the COVID era. It was a huge challenge. Then it became this, work-life balance challenge that you had. Well, do I have to come to the office? Can I be hybrid? These kinds of things were important to people. And it shows in this survey. So it's, it was a competitive job market to get the talent, because current employers are like, we can't lose it, because if we lose it, then we got to try to find it somewhere else. It was particularly hard because of the scenario I just gave. That's a real life challenge I had. I faced this multiple times. I also had a huge challenge like hiring for FP&A. Mm-hmm. I was trying to build out an FP&A team, and finding talent there, man, it was extremely difficult for various reasons, but it was difficult. So I have experience in that area, and competitive pay, work-life balance, this hybrid or remote lifestyle, things have changed. The way people are working today is not the same as it was yesterday. And I think Tony really gave the great example of the way it used to be for treasurers. It's just not the same.
Yeah, those points, Paul, bring back so many memories. I know I hated to lose an employee. And, we had a very large staff at Treasury Strategies of really, really super special people. And, every time an employee wanted to leave or talk about leaving, I kind of took that personally, as if there was some sort of personal failing on my part as, the guy running the show there. But quickly, I learned that those superstars left and the firm continued and prospered. So, to strike the right balance, we try to provide work-life balance, but in a consulting firm, you travel, you visit clients, there are demands, there are deadlines. Some people really are energized by, and others see that as it's just getting in the way of something else that they want to do. So getting that right balance and getting the right talent pool to meet the balance that you have. I frankly would be thinking about the kind of work-life balance that I can offer in my organization, and then look for talent whose profile would appreciate that particular work-life balance. So, for example, this would be an extreme, but if I were an Army officer, I would not hire a tank commander who wanted to work from home 4 days a week. It just doesn't work. And obviously the Army doesn't do that. But, that's sort of an extreme example. But if a job requires paying attention to the market around the world at odd hours, then, I've got to hire people who are interested in paying attention at odd hours and don't consider that to be an imbalance, but rather fits their unusual balance. That goes on the manager. On the employee, though, and on the job seeker, I would interview people who were clearly telling me what they thought I wanted to hear, and I would hire them. And 3 months later, there's no work-life balance in Treasury strategies. Well, I'm giving you what you signed up for.
Leadership, I think, has really changed in corporate America. There's still some of the old school ways that are in place. I think the thought process of what makes a good leader has changed. From my perspective, one of the things I have always wanted to accomplish with people that I had report to me is I wanted to see them be successful, because I knew if they were successful, then I would be successful. And it didn't matter if success meant, hey, they were moving on to somewhere else within the company or going to another company. I had a hand in their success, and so that means something. And that's important to U.S. employment writ large. And so if you're able to do that, I think as a leader, you have something you can look back on and say, hey, I accomplished a lot, not just for me personally, but for the people that I led. And that's where I think it's really important.
Yeah, that's very well said, Paul.
All those I think are very wise words. And I couldn't agree with you more that a good leader ensures that as he or her prospers or thrives, people around them, regardless of whether they work with the organization or they move on, they remain or, get as successful as them. Moving forward to our next part of the podcast, which is the final topic that I'd like you to choose, which according to you would be the biggest or the most important story of the past week and why. Paul, if I could start with you first.
Yeah, it hasn't changed since the last time we talked. My focus is on the debt ceiling. I think to me, just seeing where that goes, I do think a deal is going to get done. The question is to Tony's analogy, how much of the loaf does the Republicans get? How much do the Democrats get? We're negotiating here. There's going to be some terms that they're going to settle on. I hope they're reasonable, and where they land, I think they will. I have a feeling it's going to be a last minute deal, though. I don't think they're going to have it done tonight.
Yep. I would agree. My number one issue that I'm keeping an eye on this week is definitely the debt ceiling. I agree with Paul that there will be a deal. I don't think it's going to be very quick. I think it's going to be a little bit messy. I think we risk McCarthy and Biden striking a deal that the Senate does not initially embrace. I think we could see Joe Manchin being a wild card in the Senate, who may feel that Chuck Schumer and Joe Biden reneged on a deal they made when they got his vote for the budget increase that the Republicans now want to roll back, and sort of side with the Republicans and restore the status quo ante. And, we call that Manchin's revenge. While that's not highly likely, that is certainly a possibility and one that I'm keeping out for. I think we'll have a deal when both Matt Gaetz on the Republican side and AOC on the Democratic side both publicly say they dislike it. And if they both dislike it, then we're going to get 70% of the more moderate crowd that are going to push it across the goal line.
Yeah, I think that's right.
Well, thank you so much, Tony and Paul, for your thought-provoking analysis and comments. I would like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you so much.
This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.